Hello guys, welcome to Case Invest channel. In our last video, we have seen about what is share and what is the face value. Okay, I said that there are further more values related to share which we need to know. The next one is a book value. This is the important value when you buy a share. You have to check this value because if the company is going on bankruptcy, you will get this price only. Okay, say for example, if the Tata Motors book value is 200 rupees, but the stock price is of 421 rupees. You mean you are taking a risk of another 221 rupees. Your price 200 rupees higher than the book value. Okay, so the book value is like if the company is having asset, okay, and liabilities. So asset minus liabilities. If you deduct your total asset from your liabilities, the remaining amount you have to split and give it to your shareholder, right? So in that way, they would have calculated this book value, the company asset minus liabilities, then the remaining amount divided by number of shares. So per share, what should be the amount the shareholder will get it? That is the book value. Okay. So in case of the company is going on bankruptcy, this is the value you get it. So is that mean that I should never buy a share behind the book value? No, it is not mean. You can pay. It depends on the demand of the stock. Let me tell you about one stock. The stock name is a Page Industries. Okay, this company is famous for the innerwear. So they are making the innerwear of jockey. Okay, if you see what is the turnover, what is the profit of yearly, it might be around 2,600 crore or something. Okay, but if you know the price of the share, you will get surprised because the price of one share is 46,000. Okay, so the current market price of one share is 46,000. But if you look at the book value of the same share, it is 1,190. Okay, so the value of 1,190, people are ready to pay for a 46,000 because if the stock price is a 46,000, it means people are ready to pay, right? So if the people are buying at 46,000, so there is a demand for the stock, right? So people ready to pay even a 40 times higher, 45 times higher than the book value for a share because of what? What makes the demand for the share? They do the business for a long time as a monopoly. So in India, if you check, if there is an innerwear and this is the only one company having big market capital, okay, so companies like there is no competitor and they are with the regular profits, people believe on that company, so invest on that. And there could be one more reason on this: the company shares will be very less, like with the public, like 10% of shares with the public, and the rest of them with the shareholder and domestic investor and foreign institutional investors. So we can see who all there, but that could be the another reason. So the company might be only 10% of share will be with the public. So if they want to trade and all, so people will not sell frequently. And think about it, the company, when the people will buy the share at 20 years back, they may have bought the share at 300 rupees or 400 rupees. Now it is a 46,000. Okay, but 30 rupees, 300 rupees share. Now they are giving a dividend of yearly 1,000 rupees, even 1,000 rupees also they have given a dividend, accumulated dividend for a whole year. The cumulative dividend for the whole year would be more than 1,000 or 500. Even more than 300 is good for them, right? So what they have invested 300 rupees, they are getting as a dividend for every year. So they will never sell this share, right? Unless otherwise, if they stop giving dividends or if they start making losses, and the market price will go down. So, but that should not be the case for all the stock, that you can give more price for the stock. If the stock is having a demand and if they are doing the good business and if you hope the company is going to grow, then you can pay for it and you can pay for more than a book value. Okay. So the next value is, we have referred this value for even a face value and even a for the book value, we refer this value. This is the market price, stock price. Okay, market value. this is a original value when you have to pay from your pocket and to get the share, right? So if you want to get the share of Page Industries, you have to pay 46,000. Then only you'll get a one share, not a face value of 10 rupees or not a book value of 1,000 rupees. So you have to pay 46,000 in reality to get the stock, to get a fraction of ownership on the company. Okay, so stock price is very straightforward. Okay, so this is the value you need to pay. So if the company is announcing a dividend, the company is saying 100% dividend, it means if the stock price is 10 rupees, if the company is giving a 10 rupees of dividend, okay, they will say 100% dividend. It means it is a 100% dividend for this face value. But what about the stock price? The stock might be a 2,000 rupees you might have purchased, right? For a 2,000 rupees of stock, if they are giving only 10 rupees of dividend, it is not a 100% dividend for you. So when you invest in dividend stocks, okay, when you want a dividend, you want to make a yearly returns, in that case, you should think the dividend should be based on your stock price. So you should always calculate the dividend based on your stock price. You are beating your any other investment. Like if you are investing in a bank, you are getting a yearly interest of 6% or 5%, right? So you should beat that. Like at least you should have get a 8 to 12% of dividend in a year. It is a good price. So when you invest in we'll discuss about this more, because we have to focus on mostly on the dividend based stocks for a long time investment, how to make a returns. Okay, so the next price is IPO price. I'll explain the IPO price in my next video separately. Okay, thank you.